markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30-40 minutes or so. Packed week of events, risk events, huge risk events, big week ahead of the holiday period. We'll look briefly at how markets are shaping up. Currently, of course, we'll check out some of the technicals around the US equities, looking quite bullish on the charts, actually. So we'll check those out. Before then, just a quick review of last week's main events, which included, of course, Nonfarm payrolls report, as well as two central bank meetings, the RBA and the Bank of Canada. So we'll look at the Aussie dollar and the Canadian dollar against the dollar, US dollar, that is. Before then, jumping straight into the main events of this week. Firstly, we have US inflation data. We'll briefly look at that before then looking at those major central bank meetings. I did see that, well, policymakers from half of the G10 most traded currencies, meet this week. Interest rates for 60% of the world economy will be set in a 60-hour window, I understand. We'll focus on the three big ones, which are the Fed, of course, Wednesday, Bank of England, ECB on Thursday. And we'll just check out all the currencies around those. So obviously the DXY chart, the US dollar chart, that is, cable, so sterling against the dollar, and then euro dollar as well. If we have time as well, we'll just touch upon dollar yen, actually, after the sharp moves last week, and even the rebound that we're seeing today, just briefly. So lots to get through. Hopefully you'll stick with us for the whole time, of course. And yes, a busy few days ahead. Markets currently, Euro bourses quite mixed, really. US futures in the red. The dollar is pretty much flat. Slight bid. Yen, as I mentioned, is moving and sinking, actually, on Bank of Japan sources reports, pushing back really on any policy changes at its meeting next week. We had China's deflation situation kind of deepening with data over the weekend, CPI and PPI data softer, and that really kind of raised the prospect of potentially more stimulus, really, to boost confidence and growth again. Gold, that trades back below $2,000, really, as the expected pace of 2024 rate cuts slows effectively. While crude, I'm just checking, stabilized around $75 or so. Interestingly, US equities, and I'll just pull up a chart here for you. This is the S&P 500. They continued higher on Friday, really shrugging off that rise we saw in Treasury yields that followed the non-farm payrolls report, slightly better than expected, but really investors eyeing up the sort of Goldilocks environment for equities, this soft landing, which really is the key theme for markets, for investors at the moment. Not too hot, not too cold. The economy just ticking over nicely. This Goldilocks environment, as I say. And the S&P, well, the S&P and the NASDAQ actually closed at their highest level since March 2022 and January 2022, respectively. We've got the S&P chart here. Let me just show you this close. I'll just take off the Keltner channels that we like. But you can see here we're just on, well, the close was better than in July. And we have to go back to March for a higher, well, the high of the year, which is 46.37, you can see, but we closed at 46.04, so that's the highest close, yeah, as I say, since March last year, which you can probably see here. Just bear with me one second there, which is, yep, and then yeah, for the week, as I say, the S&P rose 0.21%, actually the sixth time in a row now. You can see those consecutive gains of weekly gains, sorry. It's actually its longest streak since November 2019. So yeah, just pausing slightly, just at the resistance at and around the sort of July highs, around 46.07 or so. But then above there, we've got that 46.37 mark. Before then, the all-time highs at 48 4.18. We're sort of 4% off now, slightly 4%, just around 4% off that record high close it was in late 2021 actually. But if you just look on the daily, you can see really nice consolidation and a sort of strong close on Friday near the highs, near the weekly highs as well. So potentially bullish consolidation. If we get past 46.07, then we're up to 46.37, as I say, and then after that, potentially into this resistance here around sort of 4700 and above, basically. So that's the S&P chart, looking pretty positive. Support otherwise around sort of 45.50 or so, looks like that would be initial support. On the Nasdaq, again, sort of consolidation really, daily consolidation, but just above that previous high from July at 15,932. We're above 16,000 now. So initial resistance at 16,166. That's the near-term high. But if you go to the weekly, you can see then we're still, some way away from that high of 16,764. Which is, that high from way back then. So some way off that in the Nasdaq. But still closing at its highest level since January last year. But yes, just noting, the near-term resistance as well. Just let's look at the Dow now. That edged up, barely edged up, actually, looking on the weekly. Just edged up in the green. Actually, it's 6 straight week of gains as well. That's its longest run of positive weeks since February 2019. So we're just now coming up towards sort of resistance around these levels from December 2021. That high was at 36,952, which is the all-time high. So really interesting breakout. Just bullish momentum here from those lows back in late October at 32,237 or 327 even, and then these consecutive weeks of gains pushing up against some resistance levels that we did have, and then that near-term July sort of top at 35,679 really surged through that, and potentially we were not even overbought on the weekly. At least we are heavily overbought on the daily. So that'll be interesting, because that looks again like bullish consolidation, but we didn't quite close on the highs for the week in the Dow. So will be interesting, contrasting with, as I say, that sort of consolidation here, but we're just bumping into that resistance, and those overbought conditions have sort of eased off slightly, but we're still approaching that sort of 70 level on the daily RSI anyway on the S&P 500. Okay, let's move on quickly to last week's main events. I'll just pull up a couple of graphics for you. First of all, of course, we had the non-farm payroll reports. A surprise to the upside, really. Non-farms grew by 199,000. October was 150, consensus 180. Really, while the end of those strikes in Detroit, the Detroit 3 strikes lifted employment by around 30,000. Job growth remains solid across most sectors, and especially services. Positively for the Fed, the labor force continued to recover a pretty brisk pace, but an even steeper rise we saw in the household measure of employment. That then pushed unemployment down to 3.7% from 3.9% expected. And you can see there, jobless rate, seen in the last projections at 3.8% for the end of this year and 4.1% for next year. But let's stress those will be changed at the meeting on Wednesday. Labour markets I've put here remain relatively tight, really, and as such, really, average hourly earnings picked up to 0.4% from 0.2% consensus, from 0.2%, sorry, prior number consensus was plus 0.3%, and that's kind of highlighting possible more persistent, slightly more persistent inflation risks, of course. I've got the pricing in there, which we'll get to on the Fed meeting for rate cuts now. Slightly pulled back on this better than expected report. Prices were sort of around a 60% markets pricing and 60% chance, I think, before the report of a March 25 basis point rate cut, but those ease back to sort of just above 40% or so currently, I think. Interesting, we did have jobs JOLTS data. That's the vacancy data, which has been of importance. That slowed more than expected actually last week as well, suggests labour markets then cooling as well on that side of things against this non-farm payroll report. Hiring slows down, and the ratio of job openings to unemployed workers actually dropped to the lowest level since August 2021. So slightly different picture to the non-farm payroll report. But it's just all around this question about how labour markets are becoming potentially better balanced without then clear signs of a growth slowdown. That's a sort of soft landing scenario and theme that everybody's concentrating on. That was non-farm payrolls. If we just move now to, we'll look at the DXY when we look at the Fed actually. We'll just move now to the, well, just before we move to RBA, you can just see on this chart, bar chart I got here, this is from last week actually, but the average Reuters poll, well, 175, consensus was actually 180. Just see sort of 199 just being on that level there. I just thought I'd leave this in just to compare it to what we have seen previously, of course, on a bar chart effectively. Yeah, so that's the non-farm payroll report, which obviously feeds into the Fed and their dot plot and summary of economic projections that we get on Wednesday. Just before we get to that, of course, we'll just look briefly as well at first of all, last week's RBA meeting. I've just pulled up here an Aussie dollar chart. The RBA, well, unsurprisingly, left rates unchanged at 4.35%. But interestingly, they did sound less hawkish than expected. That was the key takeaway, really, and that saw a sell-off in Aussie dollar, which you can see there, just highlighting that red candle there. So sharp sell-off in the Aussie dollar. Governor Bullock, who had previously stood out as a hawk, really claimed that some time is still necessary now to address the impact of rate hikes, and that whether more tightening is needed will depend on data. If you remember, they raised policy rate by 25 basis points at the previous meeting after 4 months of pausing. As progress in bringing inflation to target was developing slower than forecast. So this time, markets were, as I say, positioned for a more hawkish statement in line with that, really. And after the minutes, and as well, given the gap that there is, an unusually large gap, actually, policy meetings in the for the RBA normally monthly, but the next one is not till the 6th of February. Just take note of that. The RBA really indicated now that new information it received since has been broadly in line with expectations. And monthly data suggests really a further decline in goods inflation, although the development of services inflation remains uncertain. Wage growth had picked up since the previous meeting, but the RBA doesn't expect it to increase much further. Essentially, then, higher rates are working to establish a kind of more sustainable balance between supply and demand, as really these previous rate hikes continue to flow through into the economy. This really gives the RBA time to assess the impact of those and this now data-dependent approach. Yes, so slightly less hawkish than expected, but the door is probably still open to probably one more hike potentially, and certainly the RBA potentially might be slightly more hawkish than other central banks. A recent history really suggests quite a quick reactive function by the RBA to any sort of upside surprise in inflation markets. So that is probably what will give a bid to the Aussie going forward. On the chart, then you can see we're just hovering around the 200-day moving average, that black line at 65.74. It's also just below that halfway point of this summer decline. That is at 65.84. So we're just hovering around that. Support below 65.10, the next fib level, and then upside potentially capped by this resistance the next sort of fib level, which is around where 66.59 or so. So those are the levels for Aussie dollar going forward. Let's look now at the Bank of Canada briefly. Look at the the dollar CAD chart. BOC, they left rates unchanged at 5%. That was expected. They made some tweaks to its statement, sort of both really hawkish and dovish tones. Hawkish side sort of maintained its view that it's concerned about the risk to outlook for inflation, also maintained its guidance, prepared to raise rates further if needed. But then on the flip side, dovish side slightly, price growth is easing, economic growth slowing. And then markets really largely expect that the Bank of Canada is done with rate hikes. And Macklem as well, Governor Macklem said that policy really restrictive, probably enough for now. Pretty much then, as expected, maintain the guidance. Bank of Canada prepared to raise rates, but that really helped to keep inflation expectations anchored, but with a slowing growth and the demand side, that really should keep prices in check as well. Attention then turning to the sort of easing cycle. There was little reaction in money market pricing. I think markets now pricing around just over 100 basis points or so of easing in 2024 for the Bank of Canada. First cut priced around April, and it's unlikely we get any guidance on rate cuts shortly. Macklem, again, recently noting now is not the time to be talking about cuts, plus the Bank of Canada would be cautious over any rising inflation expectations. The December meeting was a statement only affair, actually. And then we do have Deputy Governors, Governor Gravel's speech. We have had that actually. So I'm just looking ahead actually on the calendar with the next sort of major data. I can't see pretty much, but yeah, as for the chart, dollar CAD, you can see we bumped off or held support really around the 200-day moving average of 135.15. That is the dotted line there is a halfway point of this move higher at 134.95, so sort of support around that level. The grey line is the 100-day moving average, that's at 135.85. So top side resistance, initial resistance at 136.19, that's last week's high, and then sort of support probably around these lows at 135.52 before sort of 135 zone of major support. Okay, that's dollar CAD. Let's now go to this week. So much happening this week, as I mentioned. First of all, we'll go to US CPI. That is out tomorrow. Headline expected to rise 0.1% year on year, previously 0. And then that would mean the annual number at 3.1%. So that's down from 3.2% in October. The core, that is seen unchanged at 3.6%. Just checking that. And 0.2% month on month, possibly ticking up. Yeah, to 0.3%, and that would match the October rise. Headline likely to cool due to a big drop in gasoline prices, plus used car prices also fell. But then we do have shelter costs, which potentially economists say may remain sticky, really, as their lagging effect takes time to filter through to the CPI basket. Of course, the data comes 1 day ahead of the Fed policy announcement, so kind of unlikely to shift the dial for December, but obviously may shape expectations about future Fed policy going forward, with market expectations looking for around 125 basis points of rate cuts, I think. Fed Chair Powell, just on inflation, he did remind us recently that it was still above target, though he did acknowledge it was moving in the right direction, with inflation coming down, of course, meaningfully of late. That said, he did then say he wants to see more progress, and he did then also retain optionality for resuming rate hikes if the situation demanded. That was from his fireside chat at the start of this month, and that is really what we'll get into in the Fed shortly. But really interesting comments from him, which the markets really disregarded, which was very interesting. And we will see what happens, of course, on Wednesday. So that's the CPI data. You can see that falling, as I've said, quite nicely. The red line is the core number, and the orange line, the headline number. Okay, let's move on now to the Fed. I'm just checking what we've got next on the charts here. You can see great chart from Reuters, just with the three main central banks there. So the ECB, the lower one, the higher one, the orange one is the Bank of England, and then the green one is the Fed. So you could see just the differences, much more rate cuts priced in to the ECB curve, if you like, whereas sort of Fed, Bank of England closer, but Bank of England less rate cuts priced in. So that is a higher rate overall there, you can see, or rates staying higher for longer, I should say. Okay, for the Fed then, here is a preview, a graphic with all the main numbers. They are very much likely to maintain rates at 5.25% to 5.5% at its meeting on Wednesday. Consensus really thinks the Fed is now done, though, with rate hikes, despite, as I say, Fed Chair Powell stating in that pre-meeting blackout speech that the central bank was prepared to tighten policy further if it becomes appropriate to do so. Really important to, I think, to stress that. That said, of course, softer activity numbers, slightly cooling labor market data, and really these benign inflation prints that we should see do signal that monetary policy probably is restrictive enough to bring inflation sustainably down to the Fed's target of 2% in the coming months. Of course, markets' attention is now rapidly shifting towards when the market will, the Fed will begin cutting rates. Excuse me. So really looking at some of the data, as I said, that's the CPI data and what is predicted. We've had that non-farm payroll report. And then now markets, yes, really looking for that soft landing and rate cuts pretty soon in the new year. Much will, yes, depend on the release of the updated economic projections, as well as the revised fresh dot plots to see really how many rate cuts the Fed is penciling in for next year. So just on the dot plots here, in September, if you remember, the Fed had an extra 25 basis point rate hike built in by this meeting. So if we forget that, then really it's about these 50 basis points of cuts that they had in for next year. As I say, no hike, but key is yes, if they leave those number of hikes at 50 basis points, or whether they add to the expected easing. So really the midpoint would be down from sort of 4.875% to sort of 4.625%. That would be the mid, of course. Money markets, as I say, pricing in well over 120 basis points of cuts by the end of next year. The first cut seen in May. And really with a sort of decent chance, above 40% chance that, and I think I had it here. Where do we have it? Yeah, 42% chance actually of possibly a rate cut in March. That obviously has come down after the non-farm payroll, but still is fairly high. Really then, yes, the Fed will probably be quite reticent to give weight to those market expectations, since really that risks undoing a lot of the tightening efforts to bring obviously still above target inflation back down. And we've seen those steep fall in Treasury yields in recent weeks, really meaning an easing of financial conditions on the economy. And there's probably, undoubtedly got to be some concern that really effectively unwinds some of the Fed rate hikes, as I've said, and undoes some of that work. We also get those summary of economic projections. GDP likely to be revised higher from the prior 2.1%. That could come at the expense of next year's previous 1.5% projection, though that could be hawkish if they retained it instead of basically pulling growth forward. Inflation expected to be revised lower this year and next, and that could possibly justify adding an extra cut to the dot plots for next year. So a few different things to look out for. Might be volatility because of those summary of economic projections and how they work the growth against inflation or not potentially, and it's around those 50 basis points of cuts and whether those are added to or they are stayed or remain the same. The press conference then, Fed Chair Powell may possibly look at look past those dot plots and summary of economic projections that he has done previously, and then revert back to that early December chat, as I say, that it was too premature to conclude with confidence when policy may start to ease, and the Fed was still open to tightening. That is key. That was only not so long ago, just over a week ago, so on Friday the 1st, I believe. So yes, how much has changed since then, and whether he then sticks to those comments, which would obviously be a big pushback against some of these rate cuts. You can see this chart that I had actually last week. I've kept it in there again, just these easing of financial conditions, and that is really not what the Fed wants to see. I think I said actually it was around 90 to 100 basis points of rate cuts just in 1 month that we've seen the equivalent of anyway. Okay, let's just pull up now the DXY chart, which is here. And you can see, bounce off the fib level, 61.8 of this move higher through the summer, 102.54 or so. Nice bounce off that. And then we found support again around the 200-day moving average and the halfway point of 103.46. So potentially, if we can beat these, last week's highs around 104.26, 104.20, then yeah, we push up to the next fib level at 104.38. And you've got that 100-day moving average, but the 50-day moving average as well at 105.16. So that's the DXY, and obviously a lot will affect that. Remember that the euro is a big weighting in the dollar index, 56, 57% or so. So yes, much will depend on the Fed, of course, but also the ECB, and this is kind of a flip of this chart here, which is euro dollar. Just before I get to euro dollar and the ECB, I'll just pull up another graphic with all the main numbers. ECB then, they are meeting on Thursday for the final time this year. Consensus really expecting deposit rate to stay at 4% for a second meeting in a row. Data, well, inflation has tumbled quite sharply. This is key for markets and potentially the ECB. Fallen sharply in the past few months, hitting a more than 2-year low of 2.4% for the headline in November, while the core dropped to 3.6% from 4.2%. Instrumental, really key for policymakers, of course. On the growth front, well, Q3 GDP, that's currently estimated around negative 0.1% quarter on quarter, whilst more timely survey data saw a slight pickup in the composite PMI for November, which you can see here, but ultimately still suggestive of negative growth in Q4. Labour market, the unemployment rate remains just above its historic low, and policymakers slightly concerned and have been concerned around sort of firmer wage growth. As for ECB policymakers, they've kind of been taken slightly by surprise by the speed at which inflation has come down recently. The tone's slightly shifted then to or slightly shifted in the governing council, with a rate hike really pretty much taken off the table now, and a lot of attention. I think we highlighted this before. Remarks by one of the hawks, the German hawk Schnabel, who basically noted that further hikes were rather unlikely after that November inflation data cooled. And really declined to endorse guidance for steady rates for several quarters. Those remarks really hastened all of this sort of big dovish repricing that we've seen in rate cuts for 2024. Markets pricing around a 70% chance of one by the first quarter, so by March. Even though we have had some remarks slightly dismissing that idea as well. One of the ECB members labeling a March rate cut actually as science fiction. So obviously there's big diverging, contrasting views on the governing council at the ECB. It will, of course, be President Lagarde's job to summarize all of those and give markets a picture of what the governing council as a whole is thinking. That will be interesting for sure, the press conference and how united the governing council is, of course. As for signaling for 2024 action, we do get, of course, before the press conference, we do get, of course, fresh staff macro projections, which will probably see downward revisions for both growth and inflation in 2024 and 2025. Investors really, they don't see much upsetting probably this disinflationary downward trajectory we're seeing, and combined then with the weakening economic backdrop, markets will are, as I say, pricing in a lot of rate cuts. And again, whether we see a pushback by policymakers on the ECB, similar to some of these other central banks that we're getting because of this big dovish repricing, as I say. Yeah, highly likely that then President Lagarde, ECB, will fall short of providing guidance on the timing of the first policy rate cut, while potentially repeating its call for a data-dependent stance. Even actually, President Lagarde may refer to sort of sequencing and basically respect to the stages that the ECB wants to go through, basically accelerating liquidity normalization before then talking about rate cuts. But any pushback, of course, will support the euro potentially. But obviously, we do have that Fed meeting a few hours before, the day before, the night before, really, which also could see some pushback. So will be volatile for sure in those hours. And in the meantime, of course, the euro has been under pressure. Just pull up the euro dollar chart here. You can see, yeah, the euro has been under quite strong, considerable pressure from these rate cut expectations, more, as I said, than the Fed and the Bank of England, of course. We've seen euro dollar slip below sort of 108. As I say, if President Lagarde endorses in some ways, well, no, sorry, if, let's backtrack here, sorry, if should she endorse in any way some of this market view, then certainly we would see further losses for euro dollar or for the euro. We've got 107.64, which is a fib level in there. We've got last week's low at 107.23 as a level, with a 50-day moving average just below that 107.09. So yes, if President Lagarde is in any way dovish, then yeah, we will see those lows for sure challenged. Upside, if she does back firmly against these rate cut expectations, and only says that they're data dependent, of course, and rate hike is off the table, but all options still open, then possibly we see a bid to the euro dollar. And euro, of course, we've got the 200-day moving average just above at 108.22. The next fib level, halfway point of the summer decline, is at 108.62. Okay, let's move on then to the Bank of England meeting. That is on Thursday, of course. Just before we get to that, sorry, I'll just show you just this chart from ING, just showing you in the bar chart format, sorry, just how much pricing is currently priced, embedded in the European swaps curve, basically, as I said, around 125, 130 basis points of cuts by the end of next year. Aggressive rate price cuts, or aggressive rate cuts, and consensus really thinking that the ECB will push against this as well. Okay, let's move on now to the Bank of England. Finally, Thursday, expectations again for the MPC to stand pat, maintaining the base rate at 5.25%. That would be the third consecutive meeting that policy makers really have taken stock of their actions already taken. Recent data again saw headline CPI decline very sharply to 4.6% in October from 6.7%, and the core falling as well to 5.7 from 6.1, while all important services inflation, which we've talked about a lot, the MPC look at a lot, that also fell to 6.6%. From 6.9, and the MPC forecast actually were for 6.9%. In the labour market, well, we do get labour market data out on Tuesday tomorrow. The unemployment rate fell to the 3-month period to September. That held steady at 4.2%, whilst wage growth continued to ease as the labour market loosened slightly, but ultimately not yet consistent with the MPC's inflation target. As I say, latest jobs data is released tomorrow, first thing UK time, but that all important wage growth number, 7.4% excluding bonuses, fallen from the peak of 7.9 and the previous 7.7. So watch out for that number early tomorrow UK time, as I say. And then other data points, just checking, September GDP, that expanded by 0.2% month on month, expected flat reading. And then the more timely PMI metrics, they saw the composite rise actually to 50.7, the composite UK number in November from 48.7. So above the 50 boom bust level. And services as well moved back into expansionary territory. In terms of commentary from MPC members, well, Governor Bailey he's doubled down on the higher for longer stance recently, really in an attempt to dampen this speculation about an early rate cut. There's around 80 basis points, probably a bit less now, of cuts for the Bank of England for next year. First cuts sort of around June, possibly next year. But yes, Governor Bailey certainly pushing back against any talk of rate cuts. We did, of course, get Bailey said the full effect of higher rates is yet to hit the UK, but really not a place for a discussion of rate cuts yet. We did get Chief Economist Pill saying that the middle of next year doesn't seem totally unreasonable for considering the rate stance, but then he did walk back on that by reaffirming that he assumes rates are to stay restrictive for an extensive period. Ultimately, with economic developments really not shifting enough to warrant a change in stance from the MPC, really expectations, probably we see a continued 6-3 vote in favour of keeping rates on hold. A hawkish dissent we'll probably get from Green, Haskell and Mann. And then in terms of, the policy statement, MPC will probably reiterate that policy needs to be sufficiently restrictive for sufficiently long to return inflation to the 2% target. That will be the pushback, which is expected. So anything different from that, markets will seize upon, of course. And then regarding the outlook beyond this meeting, markets, as I say, they price rate cut by June, total of around 81 basis points, I think, of cuts by year end. So expected to be a pushback. How much that pushback will be will then move sterling for sure. If we just look at finally the cable chart, so that's sterling against the dollar, which you can see here. Well, we poked up against the dollar as the Fed is being seen as less hawkish than the Bank of England, of course. Also, sterling, slight bid, really. The economy so far appears to be steering clear of recession as well. Yes, so how strongly Bailey pushes against those rate cut expectations. If he uses very strong language, then the pound should potentially see a bid. But also be wary that really needs to be backed up by upbeat data or, of course, a softer dollar. On the chart, then, you can see the halfway point of this decline at 125.89. We're below that at the moment. And then the next level would probably be around 127, these highs here from back in November. Just above 127. Otherwise, the 100-day moving average and the 200-day moving average is closest together, 124.88, 124.61, and then you've got the next fib level at 124.59. Okay, I think we'll wrap it up there, actually. Please do follow us on social media. A load of channels there, and we do also publish a daily commentary on the website with a chart of the day and more detail on the day ahead. So much happening that should prove hopefully really useful to you. Do watch out with increased volatility certainly this week. So just watch your stop levels and size positioning, I would say. That's what we'll be doing here for sure. But an exciting few days ahead. Take care out there, and we'll speak to you soon.